We will talk about sovereign debt, and in particular, we'll talk about the sovereign debt of the US economy. It was recently news that the US economy now has a debt of 31 trillion US dollar, and that is first time ever. That's the highest ever in the US history, which is about 93k US dollar per person in the US, which is actually quite high, much more than the average per capita GDP in the US. It's interesting to understand that why US, even being such a developed country, would need debt, and that to such a high debt in order to keep up the economic growth. We'll understand that. We'll also understand what is sovereign debt and why countries borrow money from outside and within the country. So the reason why we see a spike in the government debt in the US is because of the massive spending, government spending during the pandemic. So money was given to a lot of people who lost job. So that is one, and the second is the relief of the student debt. Right. So the rescue plan during the pandemic cost the government of the US 1.9 trillion US dollar, whereas the student debt relief cost the government about 750 billion, so which is quite a significant part of the GDP, and you see therefore a spike in the sovereign debt in the US. Before we get into the details about the sovereign debt in the US, we will try to understand what it is all about. So what is sovereign debt? When the tax revenue falls short of the public spending, it's very simple to understand. It's like in a family you have an income of 1000 US dollar, but you have an expenditure of 1200 US dollar. That means you're falling short of 200 US dollar, and you will have to borrow 200 US dollar from a bank or from some sort of organization, and that's exactly what a country does. So when the tax revenue, which is basically the income of a given country, falls short of the public spending, okay, so the income comes from the tax revenue for the country, and the public spending is the expenditure, right? When the tax revenue is less than the expenditure, then the country has to borrow money, right? So it's a simple formula, public deficit. So the shortest amount is called public deficit, which is tax revenue minus the expenditure, public expenditure, right? For example, on investments, building bridges and funding NASA, funding many public universities and schools, welfare systems. So in order to fund the deficit, a country has to borrow money from various parties, and we will discuss more about who actually lends money to countries, on what condition, what are the ways in which, what financial products are there for sovereign debt. We'll discuss more in detail. Okay, so how is it related to economic growth of a country? It's a very complex topic actually, so it cannot be generalized because it varies with countries. Some countries do well when they take money from outside, they borrow money, but it's not always the case. Okay, but loosely speaking, sovereign debt is actually helpful many times, because with that there is higher investment, which results in higher GDP growth, and then from that GDP you can pay back your interest and debt, and even you can increase your credit rating that way and get even more debt, and you can spend more, you can on investment. So that's a cycle actually, right? But that's not always the case. It hasn't really worked for many countries, especially the African countries, a lot of poor countries in the world. They are highly debt ridden. They have spent a lot of money on investment, but hasn't resulted in higher GDP growth, which is not nice. But there are also countries who have taken a lot of debt and they have done well. Who lends these countries money? Where do they get the money? A government can issue a lot of type of financial securities, and people can buy it. So people within the country and outside the country, they can buy it. Private enterprises or public enterprises from within the country outside of the country can also buy these securities. For instance, in the US, the government debt securities are bought by the normal people, but also from outside of the country. For example, a country like China is buying a lot of securities from the US. These debt securities. Okay, and in return they get a fixed coupon, right? Fixed interest, fixed amount of money, which is really good. And also because US securities are considered very risk free, so it's a good thing for the buyer, that you hold a very risk free security or risk free asset, and you get a coupon payment every month or every year. This is an interesting graph. You see the total global debt, it's touching 60 trillion US dollar, and I think only the US has taken over 30 trillion, I think 31 to be exact, which is I think more than the half of the total debt of the world. And imagine if US defaults, the US government defaults, what will happen to the global economy? I think it will have an impact, a huge, massive impact, right? And it's interesting actually that many developed countries are also highly debt ridden. For instance, Japan being one, US, and a lot of European countries, even though they are quite developed, they are still quite debt ridden, and in some cases the debt to GDP ratio is more than 100%. We will understand also what is debt to GDP ratio and why it is so important somewhere in this lecture. So debt to GDP is nothing but simply division of debt to GDP, right? And you expect that your total debt should not be more than your GDP. Right. In some cases it is actually, and it's not that bad, especially for highly developed countries like Japan. But for the US it is I think around 130% at the moment, or 125%, in that range. It's still quite okay because US is very good economy, whereas for some of the other countries in the Africa, it's not good at all, because the GDP is simply not good enough for the amount of debt these countries have taken. Okay, so what are the types of securities? There are many, three important one. Treasury bills, it's also known as T-bills. These are shortest term to maturity. These are short-term financing for the government. So government wants money very quickly, so it will issue T-bills or treasury bills. It's normally about for 3 months. Okay, and cost of borrowing is also very low, so it's very good for the country, for the government to get quick money to fund something important. And the cost of borrowing is low because you don't get a good return if you buy these securities. But these are fixed assets, so many people would like to buy these securities and hold them because you get some money in exchange of taking a very low risk for a couple of months time. Then you have treasury notes. Maturity is about 2 to 5 years, so it's a medium term financing. It's not a short term financing like treasury bills, but treasury notes are like between 2 to 5 years. You have interest or coupon payment each year, and then the government is required to return the money at the end of the maturity, whether it's 2-year period, it's for 3-year period, depending on what exactly is the maturity. The government has to return the money at the end of the maturity period, but you get the buyer get the fixed coupon or fixed interest over that period. And then you have treasury bonds, which are very similar to treasury notes, except the fact that this is a longer term financing where the maturity is between 10 to 30 years. And these are securities which are normally bought by government and less by the normal people. Okay, so these are institutional investors normally who invest in these kind of bonds, whether it's mutual funds, whether it's other government, for instance the Chinese government buying treasury bonds of the US. So that is one good example of that. and all other things are very similar to the treasury notes, whether it's returning the money back, whether it's getting the fixed coupon, all that remains the same except the maturity period, which is longer compared to the treasury notes. Okay, so these are the types of security. Question is, how much debt is too much? It's a difficult question to answer. So it depends on the GDP of the economy. If the GDP is quite good, for example, in Japan the GDP is well over 5 trillion US dollar, and it's a very good economy, very stable economy, highly developed country, where the debt to GDP is 250%. So debt to GDP is the total amount debt to the GDP, and it is 250%. That means if Japan's GDP is about 5 trillion, 250% of that means you multiply 2.5 to 5, which is about 12.5. Okay, so that means 12 or 13 trillion US dollar is the debt of Japan, which is still fine because Japan is quite stable economy. It doesn't pose a threat to the economy within Japan but also outside. But for emerging economy, it should not cross 100%. The debt to GDP ratio should not cross 100%, but preferably should be within 70% of the GDP. If that is the case, it's even better. But that is actually not the case. For instance, in many European, many African countries, and we'll see some of these countries, which are these countries where you see high debt to GDP ratio. Okay, so what exactly is the risk involved for the buyer of the securities? There is very low risk. You don't get good return on the security when you buy, but you get the risk involved is very low because a country is less likely to default. But there have been examples of defaults in the past. Okay, so that is there's a whole list of examples when countries defaulted. Very famous one is the Russian default, is the 90. Indonesia, for example, so the many countries who have defaulted on their debt in the past. So it's not like countries will never default, but chances are low because countries can raise the tax and increase the revenue, okay, the tax revenue, and thereby they can pay back the debt. It hasn't happened although many times, especially for the top economies, the highly developed economies like US or Japan or Germany or the UK. It's very unlikely that this country will ever default. Having said that, it is also important to note that the rating agency, like S&P and Moody's, downgraded the credit rating of the US government, I think 10 years back. Okay, so that has happened even for the US economy, which is by far the biggest economy in the world. And the interest rate on a 3 months T-bill is considered very, very, very low. In fact, in many financial calculation, when you take a risk-free interest, right? If you are from a student of finance, you know what is a capital asset pricing model. You want to price an asset. You want to know what is the expected return on a given asset, and there you use a risk-free interest rate, right? And there people use this 3 months T-bill, which is considered to be having a zero risk. Although in the real world, there's nothing is free of risk. There's some risk involved, but it is assumed that the risk is so low that it is as good as not having any risk or zero risk. But do remember that there have been times when governments have been overthrown by regimes, by military governments, by dictators, and these new governments then refuse to honor the debt taken by the previous government. So that can happen. That has happened, in fact, in many countries. So countries with lowest debt to GDP, you see Macau, Hong Kong, Brunei, Libya, Afghanistan. if you have a low to debt to GDP, doesn't mean that the economy is doing well. Some cases maybe, for instance, in Hong Kong, maybe they don't need debt, they have enough money to fund their projects. Also, it's a very small country, so not a good example. But for instance, in Afghanistan, the reason why the debt to GDP is quite low, I think the reason why, right? Because lack of trust on the government. So no one is ready to buy the securities issued by the Afghanistan government. I don't know actually whether the Taliban government, which has taken over now from the previous government supported by the US, they want to honor the debt taken by the previous government or not. So it's a question mark. I don't know, but this is a typical case where there is a takeover by the regime, and they do not want to pay back the loan taken by the previous government. Okay, and corruption is too high there, so it's very difficult for a government like Afghanistan to borrow money. And it's the same story for Libya, for example, and a lot of these African countries. But you also have highest debt to GDP, one being the Japan. Greece is one good example where it is a reasonably developed country, whereas it's quite unstable country with financial situation not being quite good ever since they had this Athens Olympic. They spent a lot of money on that in 2004 or maybe 2002, I don't remember, but I think since then they have been struggling, and the debt is just too high. It is well over 150%. It's, to be exact, it's 181% of the GDP, and Greece is not doing well financially, right? But Japan, on the other hand, is not in that bad of situation. But you also have other countries, for example, Italy having its rate of 131%. Portugal, another developed country, having 125%, very high percentage of debt to GDP. But there are also some other not so rich countries, for example Congo and Eritrea and Barbados, Lebanon, highly debt ridden, so which is not good for them. So here is this graph between US debt to GDP ratio. You see how it has increased over time. It used to be about 40% in 1970s, and it was quite stable until 1990, where it was about 60%. And from 60 to 2010, from 90 to 2010, it was about 60%, right? So, but after 2010, you see it has increased beyond 100%, which is actually massive. And you can guess as to why that has happened, because after the financial crisis of 2008 and 9, things changed. Government had to step in. Government had to bail out a lot of the banks. Government spending had to be increased because the US economy was in a recession, and during recession, government has to spend money in order to increase economic activities, and that's when it needs money and has therefore borrowed money. So on the nominal terms, you see that it was well below 10 trillion in 90s. It is now over 30 trillion, right? 31 trillion to be exact in 2022. So what exactly is the projection? The projection is that it is going to be, the debt to GDP ratio is going to be over 200% by 250. Okay, that's actually massive, right? And you see a steep increase from 2020 to 2040, right? By the way, this is projection. This is a forecast value with the data points, so it may not happen. And this, you see the timelines, right? To start with, every time there was a recession or a war, you see a spike in the debt to GDP ratio. First World War, you see an increase. Then Great Depression in 1930, you see a spike. Then World War of Second, 1945 or early 40s, you see a spike. Then you have recession, Great Recession of 2007 and 8. yeah, there you see a spike. Then you have pandemic in 2020, you again see a spike, but the pandemic, post-pandemic effect is likely to be, sustained for a long time, and therefore you expect that the debt to GDP ratio will continue to grow for next couple of decades until it touches around 200% in 2050. Then you have this breakdown of federal to state. Chunk of it is from the federal, very low part is from the state, which is quite expected, right? Because most of the government programs in the US are by the federal government, so you can expect that. Then you have this US debt ownership, and you see this is very interesting. Actually, I didn't know that, because oftentimes it is thought that the US debt is owned by the China, and US and China are the relationship is not that great, right? But if you actually look at the numbers, it says something different actually, that China or any government is not the biggest holder of the US debt. So Federal Reserve and intergovernmental holdings is having the highest percentage of it. I think the foreign international comes second. It's not the first. See the red part is the foreign and international, so which includes China, right? So and not just China, because the other countries which also hold some part of that, but the majority is coming from the Federal Reserve and the intergovernmental holdings. So that's not foreign countries, certainly not China. Then you have foreign holders, right? Many countries hold the US securities. The largest being Japan and China. Okay, China and Japan hold the massive of it. Belgium, India, Hong Kong, Luxembourg, Russia, these countries also hold some part of it, but I think majority comes from the China and the Japan. Then you have the interest payment, how it has increased over time. In the 70s it was like less than 10, like it's quite low, right? Now it is over 500 billion per year, over 500 billion. It used to be less than 100 billion in 80s, 1980, so the interest payment itself has increased by 5-fold over a period of 40 years. Quite interesting, right? So the future generation will pay for the consumption of the current generation, right? Interesting. All right, so that was it. If you have questions, please let me know in the comment section. Thank you.